Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Lion-Phillip S-REIT ETF. This video is done as a follow-up request from a viewer's comment in my previous video covering the Nikko AM Singapore STI ETF. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. The Lion-Phillip S-REIT ETF is an ETF that tracks the Morningstar Singapore Real Estate Investment Trust or REIT Yield Focus Index. There are a few companies involved in this product, so let's go through them briefly. Lion Global Investors is a Singapore-based asset management business that was rebranded in 2008 from Lion Capital Management and is the result of the merger of the asset management businesses from OCBC and Great Eastern in 2005. OCBC is the second largest banking group in Singapore, while Great Eastern is the largest and oldest life insurance company in Singapore and Malaysia. Great Eastern and Lion Global Investors are both subsidiaries of OCBC. Lion Global Investors currently has about 75 billion Sing dollars of AUM with core competencies in long-only mutual funds and ETFs across fixed income, equities, and multi-asset solutions. Given the nature of the setup, there is a notable tilt in the product offerings towards servicing OCBC retail banking business and the private banking business under the Bank of Singapore or BOS entity. Lion Global Investors also has several collaborations with other local and overseas financial firms to launch market or thematic focused products. Phillip Capital Management is the asset management business of Phillip Capital Group, a broker-dealer company founded in Singapore in 1975 and today has a global presence managing over 65 billion US dollars of assets. There is no information available on the size of the business though. From the product offerings, it can be seen that Phillip Capital Management has only a small list of funds and ETF offerings, with most of them Singapore-focused. The relationship between the two companies in this ETF is that Lion Global Investors is the manager, while Phillip Capital Management is the sub-manager. As the manager of the product, this means that this ETF is legally owned by Lion Global Investors and falls under its product offerings and AUM. Lion Global Investors is therefore responsible for ensuring the smooth running of the fund operations, as well as facing regulators and investors in all product-related matters. As the manager, Lion Global Investors technically has the right to change the sub-manager if needed, although it wouldn't make sense for this collaboration. Phillip Capital Management as the sub-manager is responsible for the actual investment management and advisory, meaning that the investment decisions to buy, sell, and adjust the portfolio is done by Phillip Capital Management. Now, given this is a passive ETF tracking a defined index, there is probably not a lot of work required, and Phillip Capital Management just need to ensure that the tracking error is minimized and that all changes in the index are duly followed up accordingly in the portfolio. Morningstar is a US-based financial services company founded in 1984. And grew very quickly by providing comprehensive financial data and analytics globally. While best known for its Morningstar Direct platform and the free public financial data and charts on its website that I use in my videos as well, Morningstar does have an indexing business where this index falls under. Let's go through the details of the Morningstar Singapore REIT Yield Focus Index. Based on the investment objective descriptions, this index actually takes exposure from another index called Morningstar Singapore REIT Index. So what is the difference between the two? The Singapore REIT Index was launched in 2016 with performance data backdated since 2007. The Singapore REIT Yield Focus Index was launched in 2017 with performance data backdated since 2010. Both are weighted using market cap free float adjusted methodology. The Singapore REIT Index has 21 constituents, just one more compared to the Singapore REIT Yield Focus Index. From this information, there doesn't seem to be much differences between the two. The only thing that stands out is that the Singapore REIT Index is base currency in US dollars, while the Singapore REIT Yield Focus Index is base currency in Sing dollars. For Singapore market, having a base currency in Sing dollars will obviously reflect a more accurate, localized performance. Another important difference comes when we compare the top constituents. Despite having nearly the same number of constituents, the top 10 constituents in the Singapore REIT Index shows significant weight allocations to CapitaLand Integrated Commercial Trust and CapitaLand Ascendas REIT compared to the rest of the positions, because these two REITs have significantly larger market cap than the rest. This skews the portfolio in a big way, and the resulting performance of the index is heavily dependent on just these two constituents. The reason why the weight allocation looks different in the Singapore REIT Yield Focus Index is because this index takes the original list of constituents from the Singapore REIT Index and put them through a normalized factor scoring system and adjusts the weights based on the quantitative measurements, financial health, and dividend yield of each constituent. The result is a much more smoothened allocation across the top 10 constituents. The top 10 constituents covers about 84% of the portfolio. So while there are 10 other REITs in the index, they don't really impact the performance much with their small allocations. In any case, these 10 or so REITs are really the more popular ones in the market for investors to look at, and they cover across the subsegments of office, industrial, retail, hospitality, data center, and diversified REITs. I think probably only the missing subsegment in the top 10 is healthcare REITs. As a result of the base currency difference and constituents difference, the performance of the two indices show some notable differences too. Investors should take note that all the Singapore REIT indices in the market are constructed differently, and therefore their associated investment products can show very different performances as well. Now that we understand the underlying index a bit better, let's go through the Lion-Phillip S-REIT ETF. This ETF is marketed as the first ETF listed in Singapore that focuses on S-REITs and leveraging on Morningstar's indexing capabilities. The investment objective indicates that the ETF uses a full physical replication approach, that is to directly invest in all the index constituents with as close as possible the weights allocated in the index. The ETF was incepted in October 2017, shortly after the index was launched. Given this is a S-REIT focused ETF, the base currency and trading currency are in Sing dollars. The ETF currently has an AUM of about 570 million Sing dollars, which is not too big, but given this is a niche investment exposure, it is expected to attract limited investors. The ETF charges a 0.5% per annum management fee. Adding other expenses gives a total expense ratio of about 0.6% per annum. This is a bit high in current investment environment, given many ETFs globally have reduced their fees. The ETF pays out distributions on a semi-annual basis, and we will take a look at the distribution yield later. The ETF fact sheet provides a full holdings list as well as a sub-industry allocation breakdown. There are some differences compared to the index constituents earlier, as the index fact sheet is dated May, while the ETF fact sheet is dated June. I didn't see this in the index documents, but there is also a footnote stating that there is a 10% cap on the holding weight that will be enforced during each index rebalancing, which is on semi-annual basis. The Lion-Phillip S-REIT ETF provides distribution announcement notices in its website, but doesn't give any distribution yield data. Morningstar has a distribution history, however upon checking, I noted that the recent distribution amounts are wrong. Looking at past distribution notices, the ETF actually states the distributions comprise of 3 parts, so it seems that Morningstar might not have captured the values of all the parts correctly. If I use these numbers to calculate, that will give about 5.6% to 6.4% distribution yield, or simplify to around 6% distribution yield per annum on average. We will see how sustainable this yield is when we look at the overall performance of the ETF. The performance of the Lion-Phillip S-REIT ETF can be found in the ETF fact sheet, and both the performance chart and tables don't look too exciting. The annualized returns over 3 years, 5 years, and since inception are flattish to slight negative, meaning an investor can probably do better going for fixed deposits instead. The performance chart also shows the ETF is staying within a tight range with slow declining trends. This is really quite an unattractive performance track record for investors to consider. To be fair, this is not the fault of the ETF, as the ETF looks to be tracking the index faithfully. The ETF performance also has less than 0.5% per annum gap versus the benchmark returns, suggesting that the ETF is actually generating slight alpha returns after factoring its management fees. So the key issue with the performance here is either the Singapore REIT market as a whole or the construct of the index. Remember, the ETF does still pay about 6% per annum distribution yield. With a flat performance, it is therefore inevitable for the NAV of the ETF to decline over time, which is clearly shown in the historical price chart available in the ETF webpage. Here is the full performance chart of the ETF versus the Morningstar Singapore REIT Yield Focus Index that it tracks, plus the Morningstar Singapore REIT Index in Sing dollars terms. We can see both indices are quite similar, though the Yield Focus Index is a little weaker in performance. That difference, however, isn't the performance killer. There is one other S-REIT specific ETF in the market from CSOP that tracks another index called iEdge S-REIT Leaders Index that is actually created by the Singapore Exchange or SGX. This ETF was launched in November 2021, and as seen in this chart, both ETFs have near identical performances. So this shows that the Morningstar Index is quite accurately reflecting the Singapore REIT market as well. That leaves us with the Singapore REIT market itself as the potential problem for the lack of performance. So let's take a look at the top 10 holdings in the ETF, since they total over 80% of the portfolio. Here are the performances of the 10 REITs plus the ETF itself since the ETF inception in 2017. As seen, the ETF performance is rather weak, surpassing only Suntec REIT. So it would have been better holding some of these individual REITs rather than going for the ETF for this time period. Looking at past 5-year time period, the performance ranking has changed. The Mapletree REITs appear to be struggling, though the ETF still lags behind all the others. Here, we start to see big differences in the performances of the Singapore REITs, from the high of 44% to the low of -21% for a 5-year time period. So if you are holding a portfolio mix of these REITs, you will likely get a return that has been averaged somewhere in the middle. Lastly, looking at past 1-year time period, we can see some changes in the performance ranking again. There are a few REITs that appear to be quite consistently doing better than the others across time periods, but this is not a REIT video, so I'll leave it for interested viewers to make your own assessments on them. The ETF continues to be in the weaker half of the group, so it does mean that picking a few of the better performing REITs in this list can give better performance results than owning the ETF. What if we move beyond REITs and look at the broader market? Here is the Lion-Phillip S-REIT ETF compared to Nikko AM Singapore STI ETF since 2017. We can see clearly that since 2021, the REIT-focused ETF has been on a declining trend, while the broader STI ETF has been on a growing trend. Now, the Nikko AM Singapore STI ETF has only about 17% in real estate sector, so there is not much REITs exposure. And in exchange, there is over 50% of financials, primarily in the 3 local banks. But the reality is banks are doing much better than REITs, so why stick to a niche market segment that is not doing so well? Finally, I want to end with this comparison chart, where we can see that the Lion-Phillip S-REIT ETF has actually delivered less returns since inception than the Fullerton Sing Dollar Cash Fund, which is one of the popular money market funds available. If the product can't do better than the money market fund, there is really no point investing in it. With that, let's summarize our findings. The Lion-Phillip S-REIT ETF is the first S-REIT ETF in the market launched through a collaboration between Lion Global Investors and Phillip Capital Management. Both are local asset management brands owned by the well-known OCBC and Phillip Capital respectively. The ETF tracks the Morningstar Singapore REIT Yield Focus Index, which has shown to do a decent job representing the S-REIT market, as it has performed similar to the iEdge S-REIT Leader Index launched by Singapore Exchange a few years later. There are no notable problems with the ETF. It has a decent size for a niche market exposure, and tracking error is low. The management fee is slightly high for ETFs these days, but still acceptable. The main problem here is that the Singapore REIT market has been on a declining trend since 2021. There is a big disparity in the performances of the REITs, and only a handful of them are generating decent returns in recent years. As such, a diversified portfolio of REITs like this ETF unfortunately gets dragged down in performance by the weaker holdings in the portfolio. While the ETF, mimicking the S-REIT market, is providing a decently high distribution yield at around 6% per annum, the fact is that the ETF is delivering a flattish return over the years, and therefore investors are simply taking out about 6% from the capital each year as income without any actual growth in the investment. The total return since the ETF inception is worse than money market funds. Therefore, there is no reason from performance perspective to consider going for this ETF or any S-REIT ETF or fund at all. Investors should be able to get better returns going for the broader Singapore equity exposure via Straits Times Index focused products, or just invest directly into the handful of better performing REITs. This concludes my absolutely biased comments on the Lion-Phillip S-REIT ETF. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.